My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends, I'm just trying to make some money. My job is not just to entertain, but to educate and teach. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. The Federal Open Market Committee has spoken, and the reverberations are going to be with us for a long time. Every year when the Fed honchos go to Jackson Hole for some R&R and togetherness, the Fed chief makes a point of being cerebral, theoretical, relaxes, waxing on the vicissitudes of the economy and the jobs. Not this time. This time, Jay Powell made it clear that he will slay inflation by any means necessary. And that includes keeping rates higher for longer. Initially, the market just hated it, with everything collapsing all at once last Friday. But today, after a nasty opening, we somewhat rebounded from our lows. Dow only dipping 184 points, S&P declining 0.67%, NASDAQ losing 1.02%, although the average actually did spend most of the days rallying from deep in the hole before giving up the gains in the last hour. I do think, though, it is dawning on people that we actually want this tougher incarnation of Jay Powell. We're all sick of inflation. We want it stopped. And maybe we are willing at last to take some pain to make it happen. I think Powell's speech was a brilliant move because his aggressive wording was the equivalent of hitting us with a quarter-point rate hike all in itself, except he didn't have to do a thing other than open his mouth. Take mortgage rates. They jumped almost 6% today because of the speech, almost a quarter-point of move. The wealth effect from lower stock prices also, it gives you a big hit, slows the economy down. Again, Powell needs to do that. He's trying to make people do a little fear of spending. He wants you to hunker down and take stock of whether you need anything else. His goal is to be stern and be tough with you about what he will do if we keep spending like crazy, both businesses and people. That's the quickest way to cool down an overheated economy. Remember, he's in a tough spot because employment's so high, but he's got to do something. Those are all good things. But let's take this forceful Powell at his word, because he basically had on Friday what I call a Volcker moment. Paul Volcker is the Fed chief who took rates to the high teens to break back of inflation in the early 80s, and it worked. But he was also the most hated man in America. We're nowhere near where we were back then, but inflation's bad enough that Powell has to act decisively, lest things get a lot worse. So what exactly does Powell want to see? First, we know what's not enough: commodity inflation. That's not going to cut it any more. He just doesn't think that matters. The vast majority of commodities have already peaked. Oil, which had fallen from $120 to the high 80s, okay, it started to bounce back, but I think this current level is in the mid-90s is the high end of oil's new range. We actually sold some of our double-weighted oil positions for the charitable trust. Of course, club members know about this, meaning we have more than 8% oil. It represents only about 4% of the S&P 500. Copper, aluminum, lumber, they're all down for the year. So many others have come down hard, too. These commodities, of course, can bounce back, but that seems unlikely with a slowing economy. And don't forget, Russia is flooding the world with oil to pay for its war against Ukraine. So that will serve as a lid around these levels. Here's, though, what I think Powell's really after. And it is, as I said, it's a tough spot. From the Fed's perspective, the most important thing is to prevent a wage price spiral, a vicious cycle where rising wages leads to rising prices, which in turn leads to rising wages again, and so on. It's a reverberation. To do that, Powell has to stop wages from growing. Specifically, he needs to see a peak in wage growth and a peak in hiring before he'll stop tightening. It might be good enough to get several months of flat wages. That might influence him. And while the unemployment rate isn't all important, Powell probably does want to see it go from, say, 3.5% to over 4% or even higher. He wants people to have a little fear of just quitting and maybe not be able to get a job. The real issue here is that while Powell may have to scare us, you and me, to spend less, he's got a worse problem that he can't do a thing about, and that's the federal government. See, the Feds have pumped tens of billions of dollars into the economy at just the wrong time. Many of the projects that Congress just authorized require highly skilled workers, and the government can pay above market rates. Good luck finding engineers for the private sector after they're fun working for the federal sector. This morning, I found myself criticizing a guest who was saying that Chairman Powell's so far behind the curve that he let too much growth happen. Now he has to throw us into a recession to cool things down. You know what? That just angered me. This wrong. It's nonsense. Much of this inflation is caused by shortages related to Russia's invasion of Ukraine. Some of it is lingering COVID hangover. There's certainly freight problems. There's obviously a lot of problems with China bringing in stuff. And now Congress just spent a fortune on hiring people right when we've already got major wage inflation. I see a major wage bid up from both the Inflation Reduction Act and the CHIPS and Science Act, which are coming on top of the big bipartisan infrastructure bill that passed last year. There's some good stuff in these bills, but the timing is terrible. If only they would have a massive housing bill to lower rents, which is what's really needed besides trying to curb wage inflation. That would be very deflationary. Let me put it this way. These three pieces of legislation would have been perfect if we had 9 to 10% unemployment, even 6 to 7%. We could maybe even handle the strain with 5% unemployment, though it wouldn't be great. But 3.5%? That will obviously add fuel to the fire. Now, we may need better infrastructure and more domestic security foundries and alternative energy, three issues that I've fought for. But right now, we need to cool down the job market, or else the Fed's going to just crush this economy. That's what happened on Friday. That's what he said. That either means more layoffs or a revamped immigration policy where we airlift engineers and programmers to the rest of the world. Politically, that's the third rail. It's not going to happen. Give this backdrop, what can Powell do? He's got two choices. Furiously dump longer-term bonds to raise mortgage rates. Sell. Or boost the short-term federal funds rate, or both. The combination would expand the cost of borrowing money dramatically. Once the Fed does that, many people will curtail their spending plans and business will postpone their expansion plans. Any company that needs financing will have a very hard time finding it. And businesses will stop competing with each other for workers. That would end the job hop. And the job hop is behind so much of the wage inflation. Now, Powell may be catching another lucky break. When I ask CEOs in Silicon Valley whether they have a hard time getting employees, they no longer indicate that it's as difficult to find people. Quite a change from last year. That's because so many startups that had done a couple rounds of financing have now found their coffers empty because nobody wants to buy the stocks of these companies. You can't do an IPO here. Same thing with the SPACs. And I think many of the software IPOs from the last 2 years are about to run out of money. Of course, there are tons of other companies that are in trouble, too, like most of the internet clothing companies, financial service companies that were fintech. I allowed people to get loans that maybe shouldn't have, much less demand for that as rates soar. Until Friday, I wasn't sure if Powell had the guts to pressure the economy with relentless rate hikes. But simply by signaling that he won't stop, as he did Friday, Powell may have a chilling effect on every bank that fears making bad loans, especially to businesses that can't tap the public markets, meaning pretty much all financial institutions worried about all loans. After Friday, we know Powell means business. What does that mean for stocks? Well, here's the bottom line. If you have stocks of companies that have great balance sheets and plenty of cash, I'm not worried about you. You'll do just fine. Companies with high dividends that give you big yields, you'll do well. But if you own the stocks of companies that are losing money, Powell's message to you is start selling now before he closes the door on their funding entirely. Let's go to Eric in Tennessee. Eric.
Thanks for taking my call. My question is in regard to CBR Group, CBRE Group, ticker CBRE. As you know, CBRE provides a wide range of services that revolve around commercial real estate. The company doesn't own the actual real estate, but rather provide services to those that do. This allows CBRE to make its money out of rental revenues and also lowers the risk rather than holding the actual properties. This model allows the company to take an asset-light approach and earn high profit margins with little leverage. CBRE currently has a PE of 14.5, price to sales of 3.4, and a debt capital of 25%.
I think the stock is inexpensive. I think Mr. Salentic is doing a good job. I think people fear that there'll be less turnover. Other people fear that there won't be as many businesses that stay in the commercial market, frankly, because of this problem with work at home. And it's the work at home problem that has made these guys' stock to be so difficult, even if that may be wrong that it's the case. Now, if you own stocks of companies that are losing money, hey, Fed Chair Powell's telling you, maybe you got to start selling it before he closes the door on their funding entirely. But if you have stocks that have good balance sheets and plenty of cash, you'll just do just fine as he tightens and tightens. On Mad Money tonight, Splunk struggled last week after earnings. So what did Wall Street dislike about the quarter? I'm going to discuss it with the top brass. Then after Friday's speech from Jay Powell, how do we get a read on the ups and downs of the markets? I'm consulting the technicals to see where we could be headed. And analysts seem to get Snowflake's quarter all wrong. But why? I'll reveal what I think is the cloud company's secret sauce, and I like it. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.